So good morning, everyone. Welcome to BDO session on professional services firms. We're covering the subject of VAT today, and as we were just saying, there's plenty to cover, as always, in the subject of VAT. Lots of things to trip us up on, so it will be a good session. So for those who don't know me, I'm Anna Gerald. I'm a tax partner at BDO, focusing on professional services firms. And today we're talking about VAT. So just to give you a little bit of an outline about BDO before we start, for those who don't know, BDO is a global accounting network. We operate in over 167 countries, 91,000 staff with over 10 billion of US dollars of revenues. And we regularly deal with our international network on professional services. So moving on to our speaker. So as I've mentioned, Ishvinza Bedi is our speaker today. And Ish is a chartered tax advisor specialising in VAT. Many years of experience of advising clients on domestic and VAT matters, and frequently visitor to our clients on professional services, focusing on all sorts of things, improving VAT controls, processes, VAT determinations, VAT recovery, frequently property actually, land related services, and a lot of focus on making tax digital and advice around the disbursement rules, making sure that everyone's complying with all of those matters. So today, and there's all sorts of things we could cover on VAT, but in particular today, we'll be talking about the COVID-19 reliefs, phase 2 of making tax digital, one-stop shop changes, the default surcharge, the electric vehicles, which are becoming more and more prevalent as we go forward in the world, early termination fees, search fees, and then some other points for consideration. And then we've also got some time at the end for questions. So in relation to questions, please do ask them as the audience with the Q&A function at the top of your screen. And we will pick up on as many questions as we can at the end, as we would normally. And if there's anything that we can't cover or we haven't got time to pick up on, we'll pick up on those with you after the webinar. So please do send through any questions that you've got. So as always, we'll be recording the webinar and we will message you with the slide deck as well as the link to the recording in a few days. And we will stick to the hour because we know that you're likely to have other things to go and do after this session, if not to rush away and pick up on some VAT points that you might have picked up on in this session. So I'll hand over to Ish. Ish, over to you.
Great. Thank you, Anna. So moving straight into the COVID-19 reliefs, wanted to pick up on a couple of points because obviously there's some things that are, I think, pressing, as well as some things that I think would be quite useful to be considering. So picking up on the VAT deferral. So as you know, at the height of the pandemic, the UK introduced an automatic payment deferral, whereby payments that were due between the 20th of March and 30th of June 2020 could be deferred until the end of March 2021. HMRC subsequently released an update saying that there would be a monthly instalment plan if actually payments can be made upfront in full by the 31st of March, and that scheme was completely voluntary. Now, when applying, you had the choice of determining the number of installments that you wanted to pay that VAT in. You could choose between 2 and 11 installments, but the number of maximum installments was limited by the date of your application. So obviously, the further you get towards the deadline of the 21st of June, then the less number of installments you would have available to you. Now, there was some uncertainty that was really created from this guidance, whilst it was helpful, and that was primarily around the position for penalties if the full payment wasn't received by the 31st of March. And that was because whilst the deadline to make that payment was the 31st of March, the deadline to apply for the monthly installments was the 21st, or is the 21st of June, i.e. next week, Monday. HMRC did say penalties could potentially be applicable, but they have now clarified their guidance to say it's only applicable if the payment hasn't been received by the 31st of March and you haven't applied for the monthly installment scheme by the 21st of June. So the key of that is really, if you haven't paid your outstanding balance yet, you need to think about getting an application in for the monthly instalment scheme this week, effectively.
Yeah, okay, so it is really important, that particular point, isn't it? So it's this week that people need to focus on that. So what else do people need to think about, Ish?
Yeah. So there's also a couple of practical points that businesses need to think about when they're applying for this. So first off, an agent can't do it for you. So if you've outsourced your VAT compliance, for example, and you think it's kind of in hand, they're not actually able to apply for that. It has to be you. You also need to make sure that you have your returns in. So if there's any outstanding returns, for example, and error corrections, that could potentially mean that you're not necessarily able to apply. So again, it's worth thinking about that and making sure that you're all up to speed. Also, the installment plan is a great offer in terms of helping taxpayers with obviously cash flow issues and with actual cash issues at the moment. But time to pay is still available to you if needs be. So it's there's a number of options available to you, but time to pay is still available if you need it. What I would recommend, obviously, is when it comes to time to pay, the more proactive you are in contacting HMRC with enough time to agree something, the better, rather than trying to agree something towards the end of a deadline. Obviously, HMRC are willing to listen to taxpayers for time to pay at the moment, so it's definitely something to consider if needs be.
Great, thanks.
Moving on to partial exemption. So HMRC also released a brief to talk about partially exempt businesses that have been affected by the pandemic. And that's because as a result of the pandemic, obviously sales revenue has been massively impacted across the board. And that can have an impact on the way in which you calculate your VAT recovery when you're doing partial exemption. So as a general rule, a lot of businesses, if they have exempt supplies and they need to work out the recoverable input tax on residual costs, they prepare a percentage, and that's based on the value of their taxable outputs over the value of their total outputs. And that percentage is the amount of is a percentage of VAT they can recover on their overheads effectively. Now, obviously, if revenue's been massively impacted, that's also going to impact on your partial exemption calculations. So you could get to a position where your recovery percentage isn't really reflective of the use of those costs. And so what can you do? HMRC have provided some guidance to say, well, in certain situations, you can override that standard method. And you can basically calculate something on use. If you're on a special method, you can also write to HMRC to agree a temporary method for VAT recovery. And HMRC have said that they will expedite that review if they think the changes that you're suggesting is only to address the changes or the impact of COVID-19. The other point to mention is if your supplies have changed at the moment, but you expect to revert back to normal at the end of the pandemic, HMRC have said that they can agree to a method that effectively uses income streams from previous years as a proxy for the current year. Because obviously, as you can imagine, COVID is an outlier in terms of the impact on business. They've also mentioned that if the method deals fairly with costs that are incurred for delayed activity, for example, using projected income, then again, that they may agree to that as well. Now, the question is, what is dealing fairly with costs? That's kind of left undescribed or undefined. So that is a point of potential contention.
Yeah, okay. So the point here is if you're partially exempt and you think that COVID has impacted on the recovery position, then there is an opportunity to mitigate this. So what are the things that we should be pulling out here?
Yeah, so I think that the key is thinking about if you are partially exempt, what is your VAT recovery looking like now as a result of COVID? It might be that you're directly impacted because you're using the standard method, which is an outputs-based method. Yeah. It may be that you have a specially agreed method which doesn't quite work given the changes that have or given the impact of COVID. Yeah. Or it could be that it technically works, but it gets you to the wrong result because actually it just doesn't fairly reflect the use of those costs. Okay. Now, if those are the cases, or if that's the case, and you think there's tax being lost there for you, or recovery of being lost there, it's worth just having a conversation to see what your options are. And again, we'd be happy to discuss that directly with you if you do have any questions.
Great.
And the other point as well is, I know a number of clients have taken this time because they have had some spare capital. They've used it to reinvest in their properties and in their developments, and that means actually they've got large capital expenditure that they need to be thinking about. And again, that can extend to this as well.
Yeah, there's certainly been a lot of sort of change in people's behaviour because of all of this, with options coming up that they may not have expected. Right, thanks.
Great. Next slide, please. So the next point that we wanted to pick up on was making tax digital. So anyone who's been on these webinars before will know I've been banging the drum about making tax digital for a number of years now. It's something that we've had basically staggered in terms of its implementation. So we've had phase 1, which has been focused on your digital records and a submission of a VAT return via an API to HMRC. We now have phase 2 coming around the corner, or actually now, depending on when your VAT return stagger is. And effectively phase 2, which is looking at your digital links and making sure you have digital links in your VAT return process, that's coming into force for all VAT returns periods starting on or after the 1st of April 2021. So something that needs to be considered now effectively. It's worth noting, obviously, previously for phase 1 and for being registrable on MTD, previously the rule was you only had to do it if your VAT registration or your taxable turnover was in excess of £85,000. HMRC's changed that position now, so they're saying actually anyone under that threshold will still be required to register for MTD for their first VAT return starting on or after 1st of April 2022. So it's basically going to encompass pretty much everyone now. So it's worth considering that point. But the immediate starting point, I suspect, with a lot of the people on the call at the moment will be that they have to get ready with phase 2 and digital links now. So next slide. So what is a digital link? So this is effectively taken from HMRC's guidance, but a digital link is effectively one where there's a transfer or exchange of data is made, and that's made electronically. So effectively, if you're talking about manual intervention, if you're manually inputting records from one report and you're putting it into another, or if you're manually copying and pasting that data into your VAT return workings, that's not going to qualify for MTD, and that's not going to qualify as a digital link. Some other examples that they mention, and this isn't so a point where you necessarily have to reinvent the wheel and have to get some snazzy new tool. Sometimes it can be something as simple as linking cells in a spreadsheet so that there is a digital link rather than a manual link. But other examples can include if you're outsourcing your VAT return and you email that data spreadsheet to your agent, that's still a digital link if the agent has a means of exporting that data, importing that data into their calculation spreadsheets. CSV imports, automated data transfer, API transfers, they can all qualify. I have also seen people setting up macros linked to a button in their spreadsheet so that it just pulls the data through. The list isn't exhaustive, and you kind of need to think about what works with your system and what works with your VAT return process. But I think the key there is that you need to be thinking about how you're getting your data in and whether that's going to be qualifying or not. So with that in mind, I did want to pick up on some practical issues that I have seen some clients face. So if you move on to the next slide, please. So first off, it's manual copying and pasting of data into a spreadsheet. And that could be for a number of reasons. One, because of the limitations in their system, because they have to raise some manual invoices, and then that's not necessarily reported accurately in their system. Because they have multiple systems, they can have an ERP system, they can have a billing system. They can also have different entities within the same VAT group, all of which can have their own reporting system, which means they're all preparing their VAT return in a different way, which then gets consolidated into a single VAT return, and that's being done manually. Those points really break the digital link requirement, and so you need to be thinking about how you can automate that. Manual calculation of the reverse charge has been a big one, and not necessarily just for professional services firms, but it has been a common issue in professional services firms, primarily because of the system that they've been using and the limitations of that system. So HMRC's position has always been that if you're required to report the reverse charge, it needs to be automated, and that can be done in system. So For example, if you have a reverse charge tax code that reports the VAT as an input and output, as a purchase, as a sale, so that it's done automatically for you, so that the AP team, as soon as they process it, the processing from a VAT perspective is done as well. But if that's not possible, and I have seen in some cases where that's not, that they expect 2 entries. So you basically report the reverse charge purchase, 1 as a purchase, but 2 as a sale. So that, again, you get the input tax, you get the output tax, you get the purchase, the net purchase, and the net sale, all reporting to your VAT return. Again, I've seen practical issues with that as well. So one of my clients, when they couldn't get it automated in the system through a tax code, and the dual entries point didn't work either, because their AP team, their access to their system was only limited to the purchasing side, so they couldn't raise a sale. And on top of that, because of the nature of their system, they could only raise a sale if it was up against an actual matter, so like a legal matter, a client matter. But you couldn't necessarily raise a dummy sale for the purposes of reporting a transaction for the reverse charge on the VAT return. So there's been quite a lot of work around getting them compliant and ways in which they can deal with that as well. So it's something that should be a relatively straightforward point, and it's always mentioned in passing, but in practical terms, there can be quite a lot of complexity there.
Yes.
And one of the other points to mention is some of the transactional data requirements. So it's not necessarily thought about as well, because it's assumed that it's in the data, particularly in the VAT reports. But from an outputs perspective, you need your net amount, your time of supply, and the VAT rate applicable, which is interesting because they mentioned VAT rate rather than the actual output tax. On the input side, they say the net amount, time of supply, and the VAT that can be recovered. Now, if you're partially exempt, you're not necessarily going to know how much VAT you're going to recover until afterwards when you calculate your partial exemption calculation. So what they have said is that you can report the total amount of input tax, and then later make an adjustment for your partial exemption, so that eventually you know the total amount of input tax that you're going to be recovering. And it's worth also mentioning that the transactional data needs to be entered no later than the date the return is made. And that's a small point that's in the legislation.
There's quite a lot of detail in this, Ish. And
Yeah.
you know, does it sound more complex and more voluminous than it actually is, or actually is this something that people are going to struggle with?
Yeah, that's a good point. I would say it kind of depends, but depending on the system and the business. So what I found is, like we said, with some of the digital links pieces, you don't have to reinvent the wheel. You don't have to do something that's super heavily involved in IT and really complex. It can literally sometimes just be a case of linking cells between one spreadsheet and another, just so that you do have that digital link. But the key is because each business and each firm prepares its VAT returns in its own way, because they have their own systems, because they have their own ways of doing things, that ultimately results in complexity on a firm by firm basis. So what may work for one firm doesn't necessarily work for another.
Yeah.
And so it's the position that we've always taken has always been, how do you prepare your VAT return? And doing like an end-to-end review of getting the data out and submitting the data or the 9 boxes to HMRC. How do you get to that number? Or those numbers, I should say. How do you prepare it? Do you do any manual copying and pasting? Are there multiple systems that are feeding into things? How do your staff expenses feed in? It's building a picture of that end-to-end process, and then you can quite quickly point out, actually, there's a manual change here, there's a manual change here, there's an adjustment here, there's a manual copying of some data here, and from there you can kind of work through and get yourself compliant. There can be a lot of complexity, there can be a lot of detail, but ultimately it's dependent on your system and the way that you do things.
Yeah, okay. And so giving yourself enough time to go through it.
Yeah, exactly. And to be fair, whilst we are now in the period in which phase 2 needs to be live, so if that process hasn't been undertaken, then it's worth undertaking that process now, because at the very least, if you can then show that you're trying to get yourself compliant, then and you can kind of get that ready for this VAT return, then obviously that's going to look a lot more favourable to HMRC. And it's also worth noting as well, if you're thinking about business risk ratings and business risk reviews, the more automated your processes for your VAT return, the less manual intervention you need to prepare your VAT return, the less risky it might be perceived to be by HMRC, and that could also have a play on your business risk rating, to the point where HMRC have also said, as a result of their business risk rating guidance, that if you are using your systems and you are trying to mitigate your risks, you would more likely be considered to be lower risk than higher risk.
Yeah, that's a good point. Thanks.
So next slide, please. So picking up on the VAT package, so these are rules that are coming into force in Europe. So not necessarily impacting on UK VAT, but this is something that I thought would be relevant to suppliers of land-related services or services in a B2C scenario that could potentially be subject to VAT overseas. So previously, the one-stop shop was a system that was designed to apply across the EU. The idea being that if you provided telecommunication, broadcasting, or electronically supplied services to individuals across the EU, instead of you having to register for VAT to pay VAT where those customers are located in each individual member state, so registering across the EU to deal with that, you could register for the one-stop shop, and that would effectively allow you to declare your sales in each EU member state with the relevant output tax. You can make a single payment to the tax authority, and the tax authority would divvy that up across the member states and pay out that VAT across Europe. So you move from having to submit multiple VAT returns across the EU with different staggers, with different reporting requirements, et cetera, to submitting one quarterly VAT return and submitting one payment, which then gets split out. Obviously, a massive simplification in terms of complying with the rules, but it only applied to telecommunication, broadcasting, and electronic supplied services. Now, a number of the clients on the call today may have been caught by electronically supplied services rules, but it's now worth pointing out that from the 1st of July 2021, the one-stop shop is being extended to cover all B2C services, which I think, again, is a massive simplification. So that stops a supplier from having to register for VAT in each individual territory where there potentially might be an obligation to register. And now you can register for the one-stop shop and pay VAT through that. Yeah, so as we're no longer part of the EU, that simplification is still available to firms based in the UK, but you would have to register for something called the non-union one-stop shop scheme, or non-union OS, and you would need to go to an EU member state to apply for that. So, which EU member state do you want to apply for? Kind of depends. Typically, you might want to see something that's a bit more favourable, a bit more easier to use. So, for example, if they're English speaking, or if their website's in English, etc. So, there's probably more practical thoughts to be thought about around that. Which then moves me on to the next slide, which is some practical points to think about. So just running through some of the guidance on this point, in terms of invoicing, the requirements will ultimately depend on the country in which you register for OS. So if, for example, you registered for the one-stop shop in France, then the invoicing requirements in France would apply. It is worth noting that when it comes to B2C transactions, the VAT invoicing requirements generally are more relaxed compared to B2B. And that is because, obviously, in a B2B scenario, in the majority of cases, the customer can recover the VAT that you're charging. That's not necessarily the case. Well, that's not going to be the case in B2C cases. So the invoicing requirements are a bit more relaxed. If you're already registered for VAT in a country for other reasons, so the example mentioned being B2B sales of goods in Germany, and you register for the one-stop shop in a different territory, so France, if you have B2C sales that are caught by the one-stop shop in Germany, you have to report that through your return in France, not through your VAT return, your German VAT return. So there is a bit of complexity around what you're reporting and where. Helpfully, I should say as well that when it comes to an intermediary or tax representative, they've made it clear that member firms or member states cannot mandate that you have a tax representative or intermediary. So it's not required, but if you want to appoint one, you can. And again, there might be practical reasons for doing that, to manage your compliance, to deal with the tax authorities. There can be a number of reasons for that. Another point that should be picked up on, and this isn't something that's new, it's something that's been for the one-stop shop for a while, is the record keeping requirements. And it's been clear that the records that you're meant to keep are for a minimum of 10 years. Now, obviously that's a lot longer than, say, the UK VAT record keeping requirements, which is 6 years. But that rule can vary in different EU member states. So obviously they've tried to get to a point that gets most member states happy. So they've gone with 10 years. So you will obviously need to keep those records for a while, and you'll need to keep those separate from, say, your normal UK VAT records. Next slide, please. And then moving on from that and kind of picking up on the actual record keeping requirements. Again, this is a list picked out from the EU Commission's guidance on the changes on the VAT package changes, and a lot of this is relatively self-explanatory. So the member state of consumption in which the goods or services supplied, type of service, and the accurate description of those services, and they can. I've noticed, particularly with HMRC, if an invoice doesn't contain the right kind of detail, they can challenge it and suggest that it's not necessarily a valid VAT invoice. Date of the supply, taxable amounts, and including currency, etc., etc. And you can, obviously you can work through this list. The main thing I wanted to pick up on is the second to last point, which is in respect to services, the information used to determine the place where the customer is established or has his permanent address or usually resides. Now, when it comes to services, particularly when we're talking about electronically supplied services, the place of supply is meant to be where the customer is, and which is why the understanding and the evidence of the location of the customer is really vital. But when you're talking about services like land-related services, where the place of supply is where the land is physically located, that the location of the resident isn't as important in terms of that determination as the location of the land that you're dealing with. So whilst they haven't specifically mentioned, if you're talking about immovable property, evidence of where that immovable property is located, I would still say you need that evidence as a record to be able to say, this is why we've charged German VAT, is because we provided architect services to on a property, specific architect property services on a property in Germany, and therefore is subject to German VAT, and that was to an individual in Germany.
Yeah, okay. So it's just on this focus on, it's B2C.
Yep.
So not B2B. Yep. So if you've got B2C, and it sounds like it's going to be a helpful change for those individuals where they've got lots of VAT overseas compliance matters to deal with. Have I got it right?
Yeah. I think it's a positive change. It has come in a little later than it was meant to. So it was delayed because of the pandemic, which is why we've got this odd start date of 1 July, and actually why some of our changes in the UK, particularly focused on goods, not necessarily services, but to align to these rules, came into force from the 1st of January. So there was a bit of a mismatch. But with this, it's definitely, I think, a helpful relief for taxpayers both in the EU and in the UK. But picking up on where I think this is most relevant, I think I see it on land-related services in particular, because that is a common issue for professional services firms. So making sure you've got that evidence, though, I think is going to be absolutely vital to be able to justify the basis on which you're charging VAT. So one, obviously, where is the location of the property, and can you evidence that? Two, can you evidence that this is a land-related service in line with EU regulations and EU law or EU guidance? Because obviously there can now be a divergence between what the UK will consider to be land-related and what the EU will consider to be land-related. So yeah, it's worth maintaining that as well.
Great.
Cool. Next slide, please. So the next thing I wanted to pick up on was around late filing penalties and late payment penalties. So as a lot of you will know, for VAT, the default surcharge regime is the regime that deals with penalties for late payments and penalties. The way it works is if you make a late payment or late submission, then HMRC will issue with a notice. That's an automated notice, and that puts you on a 12-month notice to say, if you default again, you will be subject to a penalty. and that penalty starts at 2%, and then it increases from there if you continue to make further defaults within your 12-month period. It's also worth noting that if there is a subsequent default, the 12-month period in which you're held on notice is extended by another 12 months. So obviously it's a rolling agenda, and it's a rolling issue that can be created. The problem being is that there's not much scope for mitigation, and there have been a lot of instances where businesses have triggered a large penalty by being 1 day late in their payment. So there's always been a point around how equitable and how fair this default surcharge regime actually is. So it's also been on HMRC's agenda. I think they're kind of aware of this point as well. And so they're talking about a new penalty regime to deal with late filings and late payments. From a VAT perspective, it should be within force from the 1st of April 2022. Also worth noting that it's planning to go live on income tax self-assessment as well, albeit obviously depending on the deadlines for that, but that's obviously worth thinking about. But this new penalty regime is more focused on points. The idea being that for each default, you can trigger you can earn a point or earn a point, and if you reach a certain threshold, then that's when a penalty could be triggered. And in this case, it will be a £200 penalty that will be applicable and notified by HMRC. Now, the actual threshold depends on the number of filings that you're required to make. So if you're filing on a quarterly basis, the penalty threshold will be 4 points. And if you're filing on a monthly basis, the penalty threshold will be 5 points. It's also worth noting that actually in terms of their guidance, HMRC do seem to have been quite comprehensive around some of the what if scenarios on this. So if, for example, there's 2 or more failures that relate to the same submission in the same month, then that should only trigger a single point rather than 2. Next slide, please. Some other points to think about. So the points are meant to expire after 2 years unless you reach the threshold. After reaching the threshold, the points can be accrued, that have been accrued will be reset to 0 if there's been a period of compliance with which all the submission obligations have been met in that time. And we'll get onto the period of compliance in a second. And also that the taxpayer has submitted all submissions which were due within the preceding 24 months, whether or not those have actually been late. Now, in terms of the period of compliance, that again will depend on the period of frequency that you're meant to be filing. So if you're filing on a quarterly basis, that period of compliance is 12 months. Now, if submissions haven't been filed for some reason, then those points won't just be reset to 0 because you haven't actually filed anything. So those points are meant to roll over until you actually do start filing. And it's also worth pointing out that HMRC will have time limits to levy a penalty. So they will be the ones who notify you of a penalty. They'll also be the ones to notify you of a point, of the points being applied to your account. And it's worth pointing out, obviously, if you have some points for one tax, that shouldn't roll over to VAT, so they should be held separately. It's also worth pointing out that if you're making changes to your accounting stagger, so for example, if you change to monthly returns, for example, or if you change to quarterly, or if you change your stagger, that can obviously have an impact on when you have to make a VAT return submission, and that will also then impact on the threshold negatively or positively depending on the change, but that will impact on your threshold for a penalty. There's also some other points that HMRC have mentioned around VAT groups, so saying obviously it applies to the VAT group as a whole, and they've also talked about situations where if one member joins a VAT group, what happens, or if the representative member changes and a new member comes in, what happens. Again, the liability doesn't change. If you're subject to a penalty, or if you then submit a late filing that triggers a penalty, you'll then be subject to that penalty. And finally, and I think really importantly, HMRC will have discretionary power not to levy a penalty if they think it's appropriate. Now, again, what they think is appropriate or not is something that could be a matter of contention later down the line.
Yeah, so Ish, one that where points don't meet prizes, for sure.
Yeah.
And then, but a lot of thinking seems to have gone into this. And so do you think on balance that this is going to be better for taxpayers, or is there some devil in this detail?
Yeah, I think there is a little bit of devil in the detail on this one. So, for example, like I say, with the VAT group and someone triggering a penalty and so on, and there will be some questions that will be raised. But generally, I think this is a lot more positive, mainly because of the point around discretionary power not to levy a penalty. Under the default surcharge, HMRC, it was an all or nothing thing. So they could either charge the penalty in full, or they could mitigate it completely. There was no middle ground. But because of the way that the penalty was set up, and we've seen it, there've been lots of tribunal cases where a taxpayer have said this is just not a reasonable penalty, where they've been assessed for hundreds of thousands of pounds for being a day late in their payment to HMRC. And I've seen clients where, again, it's not necessarily something that's thought about until they've triggered a £50,000 penalty. And they just don't think it's reasonable for being a day late. So I think it's more positive in that regard. The penalty position seems to be lower and seems to be less of an impact. And it seems reasonable in terms of it. You get a number of chances at it, right? So there are going to be a number of points that you have to meet in terms of the threshold before you actually do get levied a penalty. So it does seem like it's more favourable, but like you say, I think the devil will be in the detail and in the implementation.
Yeah. Okay.
Next slide, please. So this is a brief point that we wanted to mention around electric vehicles. I've seen it myself. There's been quite a few questions around how they're meant to be treating electric charging points and the VAT in regards to that. It sounds like HMRC have been getting a lot of questions as well, because they've actually released a brief on what they think their view is around the VAT recovery for charging of electric vehicles. So they made a distinction here between two different types. So if an employee is charging an EV at home, and that's for business purposes, HMRC have outright said that VAT recovery is not allowed. I suspect because they may well consider that there's going to be a lot of private use, and it's a service being provided to the individual rather than to the business, and which is why they've got to that view that they've got to. Now, if an employee is charging an EV at work, so at one of the chargers that they may have in the parking lot, and that vehicle is being used for business and private use, then that recovery is allowed. But there is a big but there, because they can either, you then need to think about two things. If you recover the VAT in full, which you're allowed to do, you then need to think about an alpha tax charge for any private use. Now, how do you do that? You kind of have to expect the employer to keep a log or keep a record of the private and business use of that vehicle. And that then means the employee has to maintain the record of the business and private use of that vehicle. And that may not necessarily be practical. The alternative is that the employer could block VAT recovery upfront. Now, that could be that they decide to block VAT recovery on the charging points, in which case there's nothing else to do because they blocked the VAT in full, or they only recover the VAT on the business use, or what they consider to be the time spent or the cost spent for business use, again, business mileage. But then again, it gets back down to the point around what records do you have to show the business to private use of that charging. And I guess fundamentally, the key is this is something that has been growing quite significantly for a number of our clients, and it's, if anything, it's only going to get more and more important. And so I wanted to raise this now as a point to think about, because if you can get the process right and set up now, such that, you know, as it does expand, or if it does expand, that you can continue to use that robust procedure, and it's in place, and there's, you know, there's less to change after the fact. One, you can mitigate the potential risk of penalties on your side, but two, it becomes easier to control, because obviously you've introduced the control, you've introduced the procedures that you need to put in place. When it was more manageable, as it grows and more employees start to charge their vehicles at the office, that procedure is now well set and in place, and so it's well followed. In theory, well followed, but it's just one of those things that, again, it just helps to just get things moving in the right way.
Yeah, we're seeing more and more things like this introduced, aren't we, into the world? So
Yep.
it's sort of trying to keep the tax catching up to reality in terms of what's practically happening. So if people are sitting there thinking, look, that's a good point, let me try and get ahead of the curve before people either come back to the office in mass or start seeing clients more regularly than perhaps they are now. What would you say to people are the practical points that they should be, or they could be thinking about implementing or going through right now?
Yep. So I think the key there is the log of the detail around business and private use. If you're going to be recovering the VAT on this, then ultimately something needs to be reported, something needs to be evidenced around the actual private and business use. So it's thinking about what might be practical for your business and what might work. So again, if employees are charging vehicles at the office, maintaining a log, I've seen, for example, people submitting their staff expenses through an app. And that could be a good way of then reporting how much private use, how much of their charge has been used for private purposes, how much has been used for business purposes. So, for example, if you know what the range is of that vehicle, and you know how many miles has been driven for business purposes, for business mileage, you can kind of work out how much might be for private use, and then work out the apportionment from that, for example. Now, that being said, I take with a lot of people with electric vehicles, the confirmed range when you buy the car isn't necessarily the actual realistic range. So that might be something that you might need to take with a bit of pinch of salt. But that's for example, one example that you could think about. Obviously, in discussion with HMRC, you may then also want to ask, is that a reasonable approach that you take? And then you roll that out. But fundamentally, if this is something that you're going to be doing, you need to be thinking about, do you block the VAT in full, or do you recover some of it, or do you recover all of it and then make an app tax charge? But something needs to be thought about there.
Fine, okay. And I know we can talk about electric vehicles throughout the rest of the session, but we better not. So shall we move on to, I think compensation is your next topic.
That's right. Yep. So compensation payments. So again, anyone who dialed into previous webinars will have seen this come up before. Back in September, HMRC issued some new guidance, which was actually quite surprising to industry, where they had said, because of some CJU case law that they consider to be in HMRC's favour, primarily focused on early termination fees and early termination payments, that they felt a lot of these payments would be subject to VAT rather than outside the scope as compensation. Their view being that if, for example, you entered into to take one of the key cases, you took a phone contract and the customer decided to exit it early, that you would then pay a fee that effectively made up the remaining contract. In HMRC's view, and in the view of the courts, that was a payment for the supply that was being provided by that phone provider. Now, HMRC have extended that to say, well, we think that potentially applies to lots of early termination fees, but also potentially to other, and in their own brief, they say to other compensation payments. And rather concerning that they also mentioned that would have retrospective effect. Now, that obviously caused a lot of confusion and a lot of challenge from industry, because it meant there was a lot of uncertainty. It meant taxpayers would have to go back, unwind positions that they took that they thought was based in case law as well as HMRC guidance, and now that would have to be unwound. Now, following lots of discussions with that, HMRC have agreed, well, look, they're going to look at their guidance. They're going to reissue some guidance on this as well. But they've decided that the updated treatment will be set out in a future brief, and it will apply from then. Now, whilst we wait for the new guidance, what they have said is that you can continue to treat such payments as consideration for contracted supply, so i.e. potentially subject to VAT, or you can go back to treating it as outside the scope of VAT if that's how you treated it before the brief was issued. So it's still something that's going to be considered. It's worth noting that I've had a recent ruling request for a client, and HMRC did confirm that they were expecting to release their new guidance in the next 2 months. So this is something as a wait and see to see where this does develop and how this is going to be applied going forward.
Yeah, and while people are waiting for that, what would you say were the key things that might come up for clients in the professional services world?
Yeah, this can still come up in a range of areas, and we've seen it come up particularly around property. So, for example, if you're talking about any sort of early cancellation charges, any sort of outside the scope penalties or fees that you may charge or maybe or may have to pay, lease renegotiations, and payments that you might make as a result of that. It can really come up in a number of different situations. And what we would say is, practically, because there's still so much uncertainty on this, you may want to think about getting as much protection around that as possible for now. So, and that protection can ultimately depends on whether you are the supplier of that charge or the recipient of that charge. So, for example, if you're the recipient of that charge, you'll want that fee to be VAT inclusive, i.e. incorporates any fee, any VAT, so that you don't have to pay anything more. Whereas obviously if you're the one levying the penalty or levying the charge, that might be outside the scope, might be taxable, you'll want to agree that that's VAT exclusive, so that it's subject to VAT on top of the payment that you're charging. It's just worth considering from both angles, obviously, in terms of what's workable, but ultimately it depends on what perspective you're looking at this from. But the general point would be, if there's any sort of outside the scope charge, whether you're on the receiving end or the one making the supply, you need to think about whether this guidance could potentially impact on you.
Yeah, okay. And this sort of thing affects the business, not just the tax team, doesn't it? So if people those negotiating those contracts need to be aware of this. It's a bit like withholding tax issues, that we make sure that the people that are signing these contracts are aware that they should be at least asking questions about this before they do so.
Exactly that. Yeah.
Right, thanks.
Okay, next slide, please. So I'm just bringing up search fees very briefly, just because actually I think this is obsolete, but some of the comments from HMRC in their brief was quite interesting. So there was a concession around not charging VAT on property search fees conducted by post. HMRC did release a brief saying that that concession was going to be withdrawn with effect from the 1st December 2020. Again, I can't imagine anyone's really going to be impacted by that. But what they did say was that Brabner's, the decision in Brabner's, which looked at electronic search fees, confirmed that such transactions or such fees weren't disbursements, and that actually they were changing this to make sure that they were consistent across the board. And in that brief, they also did confirm that they were going to be releasing new guidance on VAT and disbursements to ensure consistency. So a couple of points here. Obviously, it's an obsolete concession, which has been removed, fine. But their references to Brabner's and references to electronic search fees, and the specific reference to ensuring consistency around the VAT treatment for disbursements and the new guidance, all seems to imply that this is still quite high on their agenda. And so I just thought it was just an interesting point. One, in terms of HMRC are aware that they're meant to be releasing some guidance soon, and so we're still waiting on that. But also clearly it shows that that search fees and generally disbursements is high up on their agenda.
Yeah, as always, lots of things on the VAT agenda.
Yep. Great.
Okay.
Next slide, please. Right. And then finally, just 2 points for further consideration that we've seen in discussions with clients and in industry. So previous attendees of the webinar will note, in terms of Brexit changes, that I mentioned changes around use and enjoyment. So use and enjoyment provisions are basically rules that tax a supply depending on where they are effectively used and enjoyed. Now, those rules typically kick in if you are dealing with an EU supplier or customer and a non-EU supplier and customer. If you're within the EU, use and enjoyment wouldn't apply. Now that we're out of the EU, use and enjoyment provisions can affect us in 2 ways. One, if it applies to UK supplies to the EU, or to non-EU, I should say, for that matter. And also it can affect us in terms of the costs that we're receiving. So for example, if we're receiving a supply, but actually it turns out that it's subject to use and enjoyment, could it be subject to local overseas VAT? Could it also mean that we're potentially obligated to register for VAT overseas, depending on where the supply is deemed to be used and enjoyed? And what we have seen is that some tax authorities have been a lot more stricter around its approach on use and enjoyment and have applied it more widely than others, notably Spain, for example. So it's a point to say, if you're providing services overseas to in a B2C scenario, for example, could potentially be in a B2B scenario, you need to think about what your supply is and whether it could potentially be caught by use and enjoyment overseas. majority of the cases, you'd say probably not, but it's one of those things that needs to be thought about. Claims handling and legal services is something that has been an interesting point for a number of years. So this is particularly for, I think, the legal industry in particular, where solicitors may be appointed as an expert to deal with claims handling for an insurer, and that's typically by way of the solicitors acting as an agent for the insurer, kind of making decisions on their behalf, binding that insurer to certain claims. Now, that's been always strictly interpreted by HMRC. And there are certain conditions that need to be met. So, for example, one, the law firm needs to be acting in their capacity as an expert. They need to be acting as an agent of the insurer, and they need to be acting under the delegated authority of the insurer. So they need specific delegated authority to do this. And if you're not meeting those conditions, there's a risk that that VAT is applicable on the service. If you can meet all the conditions, it's exempt from VAT, which insurers love, because then that means they don't incur VAT on the supplies that they're receiving for claims handling services. Now, this has always been a point of contention for solicitors firms. HMRC has regularly raised it as a point to look at and to review, and there are lots of reasons why it can potentially go wrong. For example, if you work outside the scope of your delegated authority contract, potentially there's a risk there. If you move from, say, claims handling services to more litigation or post-litigation support, that's again a concern that can become taxable. And so, yeah, it's often an area that HMRC looks to assess. But what we have seen recently is that HMRC have started to write to insurers about this point as well. So if you're providing claims handling services, it's worth you may well get contacted by some of the insurers that you're working with, because they are now getting contacted by HMRC. So it's a point to think about. It could very well mean that HMRC then also contacts some of the law firms as well. But it was just a point that was raised that I thought would be interesting as well, just to flag. So it's worth getting your kind of affairs in order with regards to that.
Yeah, we're talking about such huge sums as well for some of these clients. And so, these sorts of things, if you don't get it right, you can end up with quite a substantial bill. And as you've been through, some of the penalties as well.
Yeah.
Really useful, Ish. Thank you. And as I said right at the beginning, there is a lot going on in the VAT world, and life changes, and therefore VAT tries to catch up with it. And we've got to be prepared for that. So thank you very much for all of those points. We've got a couple of minutes left, and there's a couple of questions that we can get to in that time, I think. So if we just pick up on the VAT package festival, so that is to do with the B2C that you made really clear. If a business wants to apply for a registration, how would you actually go about it? What's the practicalities around that?
It's a good question. So because we're no longer an EU member state, we would have to apply for the non-union scheme, which basically means that we have a choice of tax authority to go to say, right, we will register for the one-stop shop in your territory. And then obviously you comply through the one-stop shop through their portal. Practically speaking, most tax authorities should have had a pre-registration page open since April. So actually, whilst the change hasn't come into force yet, what you can do is, if you think you're going to be impacted by this, and actually if you think this is going to be more favorable for you to use, you can actually go to an overseas tax authority's website and make an application. Likewise, with a client that's affected, one of my clients who's actually affected through the supply of goods, we have a BDO member firm that's actually making the application for our client. So actually, you could ask us to help, and we can obviously then refer that to, say, BDO Ireland, BDO Netherlands, to whoever might be, who you might consider might be a good place to set up your registration for a number of reasons, and then we can kind of process it. We can help you with that as well.
Good. Okay, that's helpful. Thank you. And then from a Making Tax Digital perspective, when you're looking at spreadsheet links, and this is a detailed question, so I'll ask you, but let's see. So in relation to phase 2, when you're looking at spreadsheet links, can they be used within the same file? So i.e. copy data into a working tab, but then link that working tab from a VAT return tab. I don't know if that makes sense.
So are we suggesting that we can digitally link the data into the spreadsheet and then kind of copy and paste it from there?
That looks like that's the question.
Yeah. I would err on the side of the caution, and I say that there needs to be a digital link between the tabs as well. I mean, if you think about it, the whole idea of this is showing a digital audit trail from one end to the other. And if you end up kind of copying and pasting data from one tab to another tab in the same working schedule, that digital link, that follow through, that digital audit trail is kind of broken. So yeah. I would want a digital audit trail or a digital link in the same tabs in the same spreadsheet as well.
Yeah, no, that does make sense. And I guess if you can do it, then why not? To make sure that you are following that link through all the way through. Really useful. And we've got a couple of minutes left, so I'll squeeze one more in. So you talked about the renewed focus on claims handling fees. Is there any more detail that you can pick out of that that you haven't already covered?
Yeah, so I've already picked up on the point around, well, I kind of alluded to it. So like delegated authority contracts obviously are very specific in terms of what a claim handler can do and can't do. Typically, it might be limited by value, for example. So if you have a firm might be allowed to handle claims of a certain value, say £1,000 or something. You know, if you start exceeding that, like, I guess the question is then, are you doing that under delegated authority? If you're not doing it under delegated authority, are you in contradiction with the rules around expert services? Which I would say, obviously, you want to be as kind of closely aligned to the rules as possible. The pre and post litigation piece that I mentioned as well, I think is really important. HMRC have noticed it enough that they actually updated their own internal manuals on this, where they said, well, actually, we think kind of pre-litigation work, as long as it's all done under delegated authority, as long as it's all kind of claims handling services, we think that can still qualify for the exemption. But when you start talking about kind of post-litigation, you know, and you're kind of moving away from claims handling, that's very much standard rated. So again, the devil's in the detail in terms of what you've agreed with your insurers, what contracts you have in place. You know, simple things like, is there an expiry date on your delegated authority contract? You know, I would say if there's an expiry date to that, and that contract has expired, you're no longer working under delegated authority, and HMRC could potentially argue that it's standard rated, because one of the conditions that they set out, again, in their internal manuals, is that you're meant to have authorization before you start your work. Now, you did have authorization at one point, but do you still have authorization? I guess is a potential contention point.
So another one for digging out the facts before you start applying the tax to it.
Precisely.
Okay, Ish, I think we need to end it there because we're at almost at the top of the hour. So I just want to say thank you very much for all of your insights. You clearly know your stuff, which is enormously helpful to people like me. So thank you so much. As I said before, we will circulate the slides and recording to all of our attendees. But if there are any questions that are coming up in your mind that you want to run past Ish after this event, then please do let us know. Get in touch with myself or Ish or anybody else at BDO that is your normal contact, and we'll make sure that the messages get to the right place and we can help you out. Lovely. Thanks everybody for listening, and look forward to seeing you the next time.